Yo, what's good everybody? Welcome back to another video. So today we're going to be covering Fibs and the Fibonacci retracement tool and how to actually find setups using the Fibonacci retracement tool and trading opportunities. So when it comes down to Fibs, the first thing that you need to know is that this type of trading strategy really only works in a trending market. If the market's consolidating or moving sideways, you're not going to make any money using the Fibonacci retracement tool, and it's not worth putting money at risk when the market's actually sideways. You can again only use it to your advantage in a trending market. So that's the first rule when actually using Fibs. You got to be in a trending market. Second, the Fibonacci retracement tool itself, it's literally self-explanatory. All we're using this tool is to measure the retracement and where the retracement could potentially end. Now, this is a trend trading tool, meaning that it's only again going to work in trending conditions. Right now, the advantage to actually trading using Fibs is going to be pretty simple. It's going to be higher risk to reward opportunities. Now, if you guys want, you can just come over here in your trading view chart, press Fibonacci retracement, and then copy my settings. So these are going to be my settings here for the Fibonacci retracement tool. Now, how we actually place the tool is simple. You click from one point to the next point, and we're going to have a series of numbers. So we're going to have the 0, the -27, the -618. Then we're going to have the 38.20, the 50%, and the 618%. This is going to be our area where we're going to have our main focus, right? These are going to be the three levels where we're going to be looked to taking trades from. Now, depending on the market conditions, if you're in a bullish market and you're in a bearish market, there's going to be two different ways to place the tool. But really quickly, again, the only reason we use this tool is to measure the retracement or the pullback of the market and where the retracement could potentially end. Now, typically when it comes to Fibs, our 38.20 to the 618 is going to be our retracement levels. This is going to be our entry zone, right? And in between the 0 all the way to the -618 is going to be our take profit zone. And typically anything under the 618 is going to be our stop loss area, or we're not going to be looking to take a trade there at that point. So when using Fibs, right, when the market's in a bullish condition, what you're going to do is go from your previous higher low to your higher high, and that's going to be your point A and your point B. So your point A is going to be the previous higher low, and your point B is going to be the higher high. If you place the tool correctly, then the 0 should be at the high, and the 100 is going to be at the low. Now, in a bearish market, it's the opposite, right? You're going to go from your previous higher or lower high, which is your point A, to the lower low, which is your point B, right? And all we're simply doing is measuring the retracement. Now, how we're going to actually measure the retracement, let's go to the actual chart itself, is we're going to be measuring from the highest point to the lowest point, or the highest wick to the lowest wick. So in a situation like this, right, where I've seen the market make let's go over this structure here, a low, a lower high, because this high is lower than the previous high, a low, a lower high, and then a lower low, right? And going back to basic market structure, right, you have to remember a lower high is not actually considered a lower high until it makes a low or a lower low. And you know, if you're ever confused on the market structure, then just go back to the market structure section of the course. But now that price is actually at a lower low, what I could start doing is measuring the retracement and waiting for a pullback to potentially sell, right? So as you can see right here, we don't have an entry point just yet. Still no entry, because again, you have to remember our entry zone is going to be between the 38.20 and the 618. This is where we're going to be looked to making an entry, right? Again, no entry. We're still waiting for the pullback. All I'm simply going to do now is lower and adjust my Fibs, because price came a little bit lower, but we still have not made a lower high, and this is on the 4-hour time frame. The good thing about Fibs is you can measure a pullback or retracement on any time frame, right? So now we're trading inside of our entry zone, so we're going to be actively looking to take a position here. All we're simply going to wait for, again, is our entry candlesticks. which again, our entry candlesticks are our high probability engulfings, our high probability variations, or medium probability ones as well, right? So all we're gonna wait for is this, a high probability bearish engulfing. Now, also going into like the confluence section of the course, or going literally a few sections back in the video, what we're looking at here is we're also building confluence. So we're not just using fibs by itself, right? So if we were to look at the confluence on this specific trade, we have a break of structure, we have the red over blue moving averages, we have the 618 on fibs, and then we have a bearish engulfing. So once you're actually trading in the zone, right, and prices inside of the entry zone, all you're simply going to be looking for is for a bearish engulfing or a rejection off of any of these levels, which we'll go over multiple examples of, but this is the first one. Once you see this bearish engulfing bearish engulfing candlestick here, that should be the indication, and this is your sell signal. This is when you want to take your sell right when this candlestick actually closes. So you're going to go short here, and the stop loss is going to be above the 618, and your first take profit is going to be this 0, your previous low, because sometimes price won't go any lower, but it'll at least retest this low here. So now that we've put our stop loss above the 618, remember, our stop loss is a limit that we're setting for ourselves to get out of a trade, because most likely we're wrong anyways. And there might be times or situations where price may hit your stop loss, but then go and actually close right under the 618 again. That's no problem. You can just take the trade again, right? And then all we're simply going to do is look for our targets down here, right? So we know that with our first take profit, we're going to have about a 2.5 risk to reward ratio, meaning for the $100, every $100 that we're risking, we're gaining around $250. Our second target is a 3.8 risk to reward ratio, meaning that if we risk $100 on this trade, we're making $385. And our third target is going to be a 5.52 risk to reward ratio, meaning that if we're risking $100, we're making $552, right? So all we're simply going to do is let this play out, and notice how the trade didn't go in your favor right away. It came up, retested the 618, where what you could potentially do is look for like extra entries as well, as long as you're in your entry zone, right? You could have probably taken a trade off of this rejection here, right? But this is what a rejection looks like. Notice how price came all the way to the 618, tested it, and then closed right under. That is called a rejection, where you could take an aggressive position. It's possible, but it's not always recommended, especially depending on your skill level. The more experience you gain, for sure, why not? It's really up to you as a trader to determine if you want to take that risk. Right, as you can see, price came all the way down and hit the first target. So price has already made a lower low, and this is our valid lower high point. So all I'm going to be doing, and price hit the third target there, notice the immediate retracement, right? So in this situation, you would have made 5 times whatever you were risking in the span of 16 hours, I want to say, because this is a 4-hour time frame. So if you risked $1,000, you would have made $5,000. If you risked $10,000, you would have made $50,000, et cetera, et cetera. Right? So all I'm simply going to do now is wait for another pullback. So what I'm going to do is I'm going to delete this fib and start a new one. Because remember, when we're in a bearish condition, we're going to go from our previous lower high to our lower low, and we're going to wait for a pullback, right? So notice how price actually got lower here. So I'm going to adjust it again. All I'm simply going to wait for is a pullback. So I'm going to adjust the fib again, and we're going to wait for a pullback into our entry zone. And again, my point A is my previous lower high. My point B is going to be our lower low. Still, same thing. Don't have to adjust the fib just yet. Now I actually do have to adjust the fib because price got a little bit lower, and we're still waiting for a pullback. Notice how price is trading at this previous level of structure. So we're still going to wait for that pullback. As price is getting lower and lower, I'm simply just adjusting my fib. And a pullback, again, is only valid unless price tests a minimum of the 38.20. Hence why I'm not looking to take trades in this area, in this trending condition, because price didn't come up and test at 38.20. For it to be a valid lower low or a lower high or a higher low, price has to come to at least the 38.20. So this is not valid market structure. This is kind of just the market still in the middle of making that impulse, even though this is taking a few days, right? So I'm just going to kind of click through here a little faster. Now we're starting to look at an entry because we've hit our entry zone again from the 38.20 to the 618. Now we could start to look at this as being a potential pullback. So all we're simply going to wait for is our entry signal, which right here you can actually start looking to take a trade on this fib retracement because we've already rejected the 61.8 and the 50, and we've closed under the 50%. So if you go to the hour time frame, where you can actually see this big bearish variation pattern. So what you could do is take an aggressive entry off of this doji. Really, at the end of the day, it's up to the trader. Right now that we're trading in the 50%, I'm going to be actively monitoring for an entry zone. So now that we've actually formed that engulfing candlestick, this is a sign for you to actually take the trade. And again, every trader is going to take this differently. Me personally, I would have waited on this 30-minute time frame, right? Once price in the 30-minute time frame after, and this is only after seeing this big rejection, I would have waited, came here, and you would have seen this is a double top, which we've learned about already. And you could have taken the trade based off of this double top pattern on the engulfing. Then your stop loss would have been above the 618. So every time, let's say you make an entry at like the 38.20, if you have a 38.20 rejection, your stops go a little bit above the 50. If you enter above the 50% or at the 50%, your stops go a little bit above the 618. And if you enter at the 618, you're going to put your stops a little bit higher than the 618. Right? So you can think about it as the bigger the pullback, the smaller the risk that you're going to have, because once price actually breaks above the 618, most likely we're not going to be looking to actually take a trade in that direction. Right? Now, again, if we were to enter off that double top, we're looking at a 3-to-1 risk reward ratio, just about a 2.95 risk reward ratio, meaning again, every $100 that we're risking, we're looking to gain almost $300, $295, because our first target is going to be the 0. Now, when it comes down to fibs, the steeper the retracement, meaning that if price goes to the 38.20 or the 50% or the 618%, right, the longer it may take to play out. Sometimes it'll be quick, but it may take a little bit longer to actually play out. It's also healthier for price to pull back in between the 50 to 618 level because it shows signs of a good, strong, normal trend, right? And a lot of the times when we look to trade at the 50% or the 618, a nice target would be this negative 27 or this negative 61.8 here. Now, one thing I want you guys to keep in mind is just because you see your entry doesn't mean that the trade will always play out on your favor. You're going to have losses. Sometimes you may enter at the 38.20. Sometimes you may enter at the 50%. It depends, because what could happen is that price comes to your 38.20, you see your engulfing, and the price goes to the 50. All you have to wait for in this situation, again, is another engulfing. Once you see it come down and make the engulfing, it can either go in your favor or go in the 618. And then you have to kind of try again. That's what the negative about this situation or about this system is sometimes you might see your entry, but it won't play out in your favor, right? Now let's kind of just click through here. And this could have been a possible re-entry for you. So when you see things like this, where now in the 4-hour time frame, there's a double top, and you see price came all the way down to the 38.20, then came back up into the 50, where this is our entry zone, right? Well, theoretically, our entry zone is from the 38.20 to the 618. But notice how price came all the way back up. Once you would have seen that it started rejecting the 50% again, you could have looked for another entry. But again, if you were to enter somewhere along this area here, then you still have to place your stops above the 618. If you make an entry at a fib level, your stops have to go above the next fib level, right? And that's just kind of a rule of thumb, so you can allow price to fluctuate, right? Now, sometimes when it comes down to actually trading fibs, again, it may take a little bit longer for the trade to play out in your favor, especially if you're trading fibs based off the 4-hour time frame, right? Like this took a day and 12 hours for you just to be break even again, and then profit would have taken a day and 20 hours, right? So let's just kind of continue here. right? Let's continue. So right here, you could have taken profit. Ultimately, it's up to the trader. I would have held the position, right? Because again, we're waiting for our stop loss, or not our stop loss, or take profit ultimately to get hit. And really, it depends on the trade itself. There's a lot of things you could do for active trading management. Like at this point in time, you definitely 100% could have taken profit here. One thing you can also do is trail your stop losses. So if price is at a 1-to-1 risk to reward ratio, move your stops to break even, right? And then look to trail your stop loss, at least so you have a risk-free trade. And then, you know, in a situation like this, you would have really, the best thing for you to do is leave your fib kind of alone. You would have seen price pull back to 38.20. Now, if price breaks above this high here, then it's invalid because price did come down and make a low. What you could also do is look for another fib within this area and seeing price pull back to the 618 here. So notice, I'm going to kind of get rid of this one here. Notice how price came all the way down, made a low, then came back up and actually closed above the 618, then closed right under. Came back above, then closed right under. Once it closed right under, the trade is still valid. It's a little bit more than a 618 retracement, but all you simply have to do again is really just a stop loss adjustment, right? Even here, notice how momentum is slowing down. The goal with trading fibs is to try and get in as close to the level as possible, right? Stops go above the 618, and then we can kind of continue here, right? And then you can see price actually did hit that entry zone there, right? Or hit our targets there. But you could trade fibs on multiple time frames, but just know that it could take a while for your trades to actually play out. You can even use fibs on the hour time frame as well to try and catch more intraday moves. What you could do is if price is actually trending, right, and making lower lows and lower highs, it's the same concept. We're just literally placing them on the hourly time frame. Now, when it comes to the daily, sometimes, or the 4-hour, sometimes you won't have an opportunity to place fibs because the trend is so steep. Even if you go on the hour time frame, right, all you're really looking for is market structure, lower lows, lower highs, right? In a situation like this where the trend is very steep, it's very hard to do so. But what we could see here with this market structure here in this intraday time frame is price been a higher high, then a higher low, then a higher high. Once you've identified this, you can actually go down, place a fib from your high, higher low to your higher high. And then let's keep one thing in mind, right? Notice initially price came all the way down to the 618, rejected, bearish variation. In a situation like this, it's too late to make an entry, right? But notice also, let's exit this. Let me go back. Sorry, I don't know why my computer is a little bit laggy. But notice also how price, you would have had to attempt multiple entries because right here, it's too late for you to enter. If you didn't enter near the 50 or the 618, it's too late for you to make an entry because price is almost at the high, right? And then the price came down to the 38.20 and you have a rejection. So you could have a possible entry here and then your stop loss would go under the 50% with the first initial take profit being here. Now notice how the risk reward ratio is actually negative. In a situation like this, you do not want to take a trade because the trade isn't worth it unless price were to come up to here. But then even then you only have a 1.8 risk reward ratio. Guys, if the risk reward ratio doesn't make sense, then the trade doesn't make sense and it's not worth you taking. Now notice how price came all the way down. It's still trading lower and lower. And now we're at the 618. So now we can still wait for an entry. Now what we could do as well is go down to a 30-minute time frame and look at what this market structure looks at. So notice how price had a rejection of the 618 here because remember, this is our point A and this is our point B. So anything before that, we're not looking at because that's an impulse to the upside. It's everything after that. And remember, going back to the pullback section, all this simply is a complex pullback, meaning that the market most likely had a huge run, which it did, and it needs a little time to breathe, which is going to happen. You have to be patient. Now, in the 30-minute time frame, seeing the 618 rejected twice, I would make an entry here, knowing that it's a little bit of a higher risk entry especially, well, in theory, you're entering at this engulfing, so you wouldn't see this candlestick, right? And it's a high probability entry. So your stop loss can go under the 618, and our TP1 is going to make us a roughly a 1 to 2 risk reward ratio. So 1.8, meaning if I risk $100, I'm going to make around $180. Our TP2 is going to make us about a 3 to 1, and our TP3 is going to make us about 4 times our risk, which now this trade makes a lot more sense. Now you could do is kind of click through this. Now we're in profit. Price slows down a little bit. And it's continuing. Again, you have to hold your position, right? Seeing this drawdown, you were up, let's say if you did a one lot, you were up $240 at one point and then pretty much break even. You have to be able to sit on your hands and hold your positions as best as you possibly could, because you have to look at the risk to reward ratio of your trades. Sometimes price will do this where you're in profit and then hits your stop loss. It's going to happen. Your trades aren't always going to be playing out in your favor, but you have to hold your trades as long as you possibly can so you can meet your risk reward ratios. Because again, the point of trading is to try and pay for our future trades. Now here, take profit when it's hit, so you can move your stop loss to break even or put it under that low right there. We're going to continue to hold. And in this situation, your stop loss would not have been hit, right? But what you could do now is pull another Fibonacci retracement tool from our higher low being here to our high, right? Seeing the 618 pullback in a situation where you're using fibs on like an hour time frame and a 30-minute time frame, you could make an entry based off like a 5-minute or a 15-minute. It's a little bit riskier because there's more volatility, but I'm trying to keep things a little bit simpler for you guys. So now let's look at the risk reward ratio if we would have taken a trade here. And I can tell you guys right now, based off experience, the risk reward ratio is going to be very poor, so it's not even worth taking a position here, because if we place our stops under the 618 and we target the 0, that's a negative risk reward ratio. Price will have to come to our TP3 on our first position just to make that back, which ultimately it's up to you as a trader if you want to take this position for 2 times your risk, which you could, right? And let's see how that would have played out for you, right? So your price almost came down to the stop loss, but notice how it's still trading above the 50 SMA. Again, it's confluence. Now, let's see if we would have gotten a better entry here if we would have gone down to like a 15-minute time frame. And you could use this time frame correlation altogether, because what this looks like to me is a double bottom. Now, I don't know why my Wi-Fi is lagging, but I'm going to pause the recording real quick until the chart actually loads again. Alright guys, so as you can see, price did make that double bottom. So here would have definitely been a way better entry for you if you wanted to take that position. And we've increased our risk reward ratio to a 2.5, and we can lower our stop loss a little bit, so about 3 times our risk. But let's play the trade and see how this would have gone. Let's just kind of keep going here. I'm just going to kind of press play, see how this would have played out. So there goes price hitting our second take profit on our first position, because remember, we're targeting here. Now what we could do is move our stop loss up to the next higher low on this hour time frame, which is going to be under here. So both of our stop losses are pretty safe. Now we have a new higher high. Let's continue to see if our third take profit would have been hit, and it was hit. So now this is our higher high here. What we could do is start trailing our fibs. Let's press play. Nothing just yet. As you can see, sometimes you may never get that pullback that you're looking for, right? But that's the positive about fib trading, because sometimes, imagine if you were still holding this position from all the way down here, right? If you could find a way on how you could trail your stop loss, you could have probably caught this entire move. Right, so I believe our entry point was somewhere along here, I want to say, right, with our stop loss being down here. It was something like this. Now imagine catching this move just by simply trailing your stop loss. You would have made 8 times your risk. So if you would have risked $10,000, you would have made $80,000. Right? If you would have risked $1,000, you would have made $8,000, which that's how you pay for your future trades, right? And then if you take a look at like the 4-hour time frame, we could probably see it's just one big impulse to the upside, and that's going to happen. Sometimes you're not going to have that entry point. But now let's take a look at things from a break of structure perspective, because what we could see here is this lower high. Now notice how price actually came and broke above the lower high, making a higher high. This would definitely be a way better intraday perspective, a way better intraday entry point, right? So initially price came up, made a high, then a higher low, then a higher high. So you could have measured fibs from either this point down here to this point, seeing that it was almost a 38.20, we're going to continue to move it forward. So now this is a valid 38.20 rejection. Price came down to the 38.20, made a higher low. And again, ultimately it's up to you as a trader. My entry, if I'm going to be trading the 4-hour time frame, then you could be looking to take a more swing trading position on the 4-hour time frame, and you can flip between the 4-hour time frame and the 2-hour time frame, right, for entries, which you can see things a little bit more in detail here as well. And you can also use a 4-hour time frame as well for direction and for entries. Again, it's really up to you. If you're going to be trading the 4-hour time frame, you can make entries on either the 4-hour or the 2-hour. If you're going to be trading on the hour time frame, which is an intraday perspective, then you could use the hour, the 30-minute, or the 15-minute for entries. So let's say I would have gone down to like the 30-minute time frame. Let's see what this would have looked like. Me personally, I like the 30-minute time frame because it shows me just enough detail, which in a situation like this, it's a little bit messier, right? So here we have a nice bullish variation right off of support. And again, notice how I'm using confluence. So this was our previous, this red line here was our previous level of resistance, our previous high. Notice price double bottom off our previous high. We also have the blue for red moving averages. And then we have a double bottom right here, right? This would have been a nice entry for you, right? And again, the more confluence you have, the higher the probability the trade is going to be. Right now, with the 38.20 rejection, let's take a look at our risk-reward ratio with our TP1. It would have been a 1-to-3. Not the best, but if we would have looked at TP2, we could have probably made almost 3 times our risk, which in a situation like this where we have price breaking structure, a third leg is typically going to happen, right? And this is a third leg on the 4-hour time frame because we have point A, point B, point C, right? So we have a 3-leg extension here confirming the bullish trend. And then you can see price in this situation just went up and hit that order there. Then notice how price actually came all the way back down, bounced off our previous market structure level again, which you have to keep in mind. Every time frame has its own level of structure. Remember how I said, right, this is probably just the beginning of a 3-leg extension on the 4-hour time frame. You could pull a fib from here to here. This is why the 4-hour time frame is always going to be much, much cleaner, right? Notice how price pulled all the way back down to the 38.20. Because remember, if you see the hour time frame have a big bearish move and start breaking under the moving average, check the 4-hour time frame. Consult with the 4-hour time frame. Now that you see that the 4 hours at the 38.20 and it's still bullish, it broke above this structure level here, and notice again, came all the way back down to the previous higher low. You know what this looks like to me? Point A, point B, lower high, lower low, higher high, and then pull back to our previous level of structure where we have this previous higher low point, and we have a big move to the upside. Here you have your engulfing, which is your first entry signal. Stop loss goes a little bit under the 50%. I like to put it in between the 50 and the 618 roughly. And then our first TP would have been roughly a 1-to-1. TP2 would have been a 1-to-2. TP3 would have been a 3.7. And then notice price continue to trade higher after that for a very long time. So again, if you could have found a way to trail your stop loss, you could have potentially caught this entire move and make 8 times your risk. Again, ultimately it's up to the trader at the end of the day how they're going to trade things. Anyways, guys, I feel like this video got too long, but hopefully you guys understand how to trade fibs. I'll talk to everybody within the next video.